It is often stated putting pre-tax dollars in your tax-deferred retirement plan will give you more after-tax income during retirement. This is because you are not only receiving growth on the money that would have gone to pay taxes, but you are also receiving growth on the growth, giving you triple compounding. Let's look at two different scenarios to demonstrate this. Scenario number one is an individual contributing $6,000 per year for 30 years into a tax-deferred retirement plan. And let's say they are in the 25% tax bracket, and hypothetically, they had a 10% annual rate of return. $6,000 a year times 30 years with a 10% annual growth equals $1,085,561. Now, to keep everything equal for this comparison, let's pretend, hypothetically, you could withdraw the full amount at age 65 and pay 25% tax. 25% of $1,085,561 is $271,390, and your ending account balance would be $814,170. Now let's compare that to someone who contributed $6,000 per year for 30 years into a Roth IRA. Here, the money going in has been taxed. However, because it has been taxed going in, it is not taxed on withdrawal. You also receive tax-exempt growth, meaning you do not pay taxes each year on the fund's growth, and neither deposits nor earnings are taxed on withdrawal. Regarding Social Security, since withdrawals from your Roth IRA are not considered taxable income, this money is not counted when determining if you will owe taxes on your Social Security benefits. Assuming a 25% tax bracket and a $6,000 contribution, your net after-tax contribution would be $4,500. $4,500 times 30 years at a 10% annual growth equals $814,265 with no income tax due. So with tax brackets and growth rates being equal, the ending account balance in both scenarios is $814,000. There is no additional benefit for waiting until retirement to pay the income tax unless you know you will be in a lower tax bracket. That is the only way you win. However, there are multiple ways to lose. Number one, the federal government increases income taxes. If you drop from a 25% bracket during your working years to a 15% bracket in retirement, and the government increases federal income tax by 10% or more, you lose. Number two, the state government increases income taxes. This is the same scenario. Number three, a successful career. Let's say you start out your career in a 15% tax bracket. Later, you move up to a 25% tax bracket. You finish your career in a 35% tax bracket, and you retire in a 25% tax bracket. You lose money on every dollar deposited into your account during the years you were in a 15% tax bracket. You break even or lose money because of inflation on every dollar deposited during the years you were in the 25% tax bracket. Number four, inflation. You deposit a dollar into your tax-deferred plan when you were in the 25% tax bracket, deferring 25 cents, and gas is $1 a gallon. You're now retired in the 15% tax bracket, and gas is $2 a gallon. You withdraw $2 and pay 30 cents in income tax to buy the same gallon of gas. Number five, tax deduction. Typically, during your working years, you will have other tax deductions, such as a mortgage and children, to offset taxable income. During retirement, the mortgage is paid off and the children have moved out, increasing the likelihood of paying the full taxable amount on the dollars you withdraw from your tax-deferred plan. With only one way to win and multiple ways to lose, and the looming tax crisis, removing some or all of your retirement funds from the income tax system will become an ever-increasing priority.